All right, guys, we need to talk. We really need to talk. There's a lot to talk about. I first off want to skip the intro, get straight into the info. First and foremost, you've seen a lot of people that have turned bearish on AMC. And believe it or not, that is actually an incredibly bullish thing. Name me one stock that did very, very well that everybody was bullish on. Name me one stock down below in the comment section. Even Tesla had a very bearish tilt towards it. People did not like that stock in 2018, 2019. There was one of the highest short interest levels on Tesla, and look what that has done. Look at AMC or GameStop the first time around when people thought these stocks were going out of business. The bearish sentiment could not be higher. What happened? Everybody was proven wrong. The sentiment switched very fast from bearish to bullish. Everybody wanted to trade these stocks. Now you're seeing that sentiment switching back to the bearish side. And I know that does not go for everybody. That's just summing everybody up by and large. So what does that mean is ultimately coming? Another rally. But a rally does not mean the MOAS. The MOAS will come when a big rally comes because of what I'm talking about next here in this video. So I wanted to put that out there, why it's actually a bullish thing to see the sentiment turning from bullish to bearish. It's very hard to make a lot of money in a stock where everybody is bullish on it. It's a fact. Once people are super bullish, you start to see a lot of manipulation. You start to see a lot of shorting, and hedge funds, institutions, they do whatever they can to keep the stock down. Once they ease off on that, once the bearish sentiment comes down, history speaks for itself. You do tend to see some pretty crazy rallies. And if you just think back to any stock that went crazy, people hated it before it went crazy. So just got to put that out there. The other things that I want to talk about is really what has happened in the last couple of weeks, because people don't understand really the significance here and the big domino that fell in our favor. So take a look at this. Western banks' exposure to Russia by the numbers. Italy, 33 billion. France, 32.7 billion. United States, 25 billion. Australia, 22 billion. Japan, 11.5 billion. And gets smaller and smaller down here. But all foreign banks, $160 billion. Not including America's $25 billion. And an additional, I believe, $49 billion of indirect exposure that banks have came out and said, right? Banks, they don't like to come out and say, hey, we have a lot of money in this country that is now about to go bankrupt and we're just going to lose a lot of money. They don't like to do that. So it usually comes out in audits, or it comes out on earnings reports when those audits actually happen. Now, these are the numbers that we can prove. And as we know, the numbers you can't prove are often larger than the numbers you can prove, or the numbers that they fess up to. But really the key with this, because 160 billion plus 25 billion, that's 185 billion. That's about half the size of the liabilities for Evergrande, which it's a lot of money. It's not a good thing, but it's not the end of the financial system. What is really going on here and what is really bad about all of this is the indirect exposure. It is the collateral that is used to, keep these positions open. It is the derivatives that are put on these positions. It is, say, the American banks investing in European banks that have a lot of exposure to Russia. And that indirect exposure, if a European bank starts to do bad or goes under, which a lot of them are very close to going under, you'd be very surprised. Just look up European bank crisis, and there's a lot of them that are not in good situations before this Russian crisis happened. So you're gonna see a lot of banks with a lot of indirect exposure invested in hedge funds, institutions, other banks that have direct exposure in Russia, and that's where the real credit crisis scenario comes about with this whole Russia situation. These numbers are huge. It would not surprise me if total direct and indirect exposure to Russia is over $1 trillion. Think back to 2008. What almost stopped and completely seized the financial markets? It wasn't necessarily giving out bad mortgage loans, giving out ninja loans, no income, no job loans. Wasn't necessarily that. We could have dealt with that with the 8 to 12% foreclosure rate we've seen. Not good. We could have dealt with that. What really happened is the banks were betting on derivatives around mortgages. And they do that to this day. It's called hedging. And that has been going on with these Russian assets. And when they go to zero as fast as they did, you end up taking massive losses and you really don't have a chance to get out of those losses. So it's really the derivative exposure here, and it's really the indirect exposure here to a lot of hedge funds, international banks, as well as institutions by a lot of American banks that are really going to cause the problem. And this could take a couple months. This is not something you're going to hear about tomorrow. It's something that's going to slowly leak out over time instead of just one day. Like we've seen today, JP Morgan gave their stance on their direct exposure, which was limited. Goldman Sachs said they had $960 million of direct exposure to Russia. Citigroup, I can respect them for this, but they have said they had $10 billion of direct exposure to Russia, over 10% of their current market cap. So we'll have to wait and see exactly how that goes. But as well as that, you have China, as Trump would say. That is in a very bad situation. Nobody talks about this, but this situation is not getting any better. It says China's giant housing market has continued to decline in the past month, and another major developer showed signs of financial distress as state-owned enterprises began carving up the carcass of the fallen property giant Evergrande. And it says contracted sales for the top 100 developers fell 9% for all of last year, according to figures from China Real Estate Information Corp, reflecting declines in both prices and volumes. Now, do you guys think there's a real estate bubble going on in America? Do you think real estate is expensive? Well, you haven't seen anything yet. Head to China. It says real estate prices in China are now 2.6 times higher than in the US. That's ridiculous. Imagine the derivative exposure that is happening in the Chinese real estate market. Things have been good for so long. Real estate since 2004 in China has went up over 600%. Why would you not bet on that bet? It's been pretty good. The Chinese government, are they going to let it fail? People probably didn't think so. But all things that are like this, that are bad financially, the government really can't do all too much because they devalue their currency. When investors find word that the whole real estate market is collapsing, the yen is going to plummet through the floor. Investors are going to pull out money. There's no literal way out of these kind of situations unless you take massive financial pain. But it says Nikkei estimated the total market value of housing in China in 2020 to be $95.6 trillion. So call it $100 trillion. Real estate market goes down 9%, you just lost $9 trillion. If it goes down 20%, you just lost $20 trillion. Let alone if that is 5x leverage, you lost $100 trillion. That is a global recession. There's no other way around that. You're going to be in massive amounts of pain. The markets are going to feel pain. The hedge funds, institutions, the banks, the countries, everybody is going to feel pain. And I'm saying this is only a matter of time. And all of these financial entities are directly interconnected. Hedge funds, institutions, banks, and countries, they're all connected. There's a lot of American investment in China, not so much in Russia, but I think there's a lot of indirect exposure to Russia for American banks, like we went over earlier in this video. So Russia has fallen. China is on the verge of falling, and that is going to happen this year, in my personal opinion. People forget to realize that when America went down in 2008, when the debt crisis happened because of all of the over leveraging and the collateralized debt obligations that were basically being bet on that all went bust at the same time. That took 1 year. And we only really started to hear about Evergrande and the situation going on over there in late August, October-ish. So that's when I would expect a dramatic reduction in liquidity around the world. What happens in China, what's going on in Russia, it's going to affect us. There's no other way. There's no other way around that. So hedge funds, institutions, banks, everybody will have less money. They will start demanding more collateral, more margin for all of these margin loans that are out in the marketplace. That's how it works. Banks are out to protect themselves. Just like we've seen today, oil futures, banks are now demanding 90% more margin because they are very volatile and the liquidity situation is probably not looking so good on that front. That's just an example. When things get tough, banks, they demand more moolah. When hedge funds and institutions don't have that money, they have a couple options. They can raise capital, they can sell stocks, they can cover on short positions and get their collateral back to service that increase to their margin call. Now, shorts, they don't like to cover on their short positions until they have to. And this liquidity crisis will not be a one-day event like, hey, we need more money, Mr. Hedge Fund, deposit it or we will liquidate your portfolio. It's not going to be a one-day event. It's going to be a periodic, just within a stretch of if short positions start to go against them in a dramatic way, there's not going to be that much money in the pool. Imagine it like a market maker that has to hedge out for the possible upside when you buy a call. They have to hedge out immediately because they are exposed to a lot of risk. That's the scenario that we're going to be heading into, but on the opposite side, for the institutions that have short positions that really have to hedge out immediately or close out of their positions immediately when these short positions start to go against them or once their stocks start to fall that they are long on. Hopefully that made some sense. Rewind it a couple times so you get the gist of that. But putting this all together, when are all of the effects from Russia going to set in? When are all of the effects of this China situation going to set in? Well, I think it's pretty clear that we're looking at really late summer to the fall time frame. Really, I would say from, end of August through really December through November is when I expect the credit crisis to hit its peak, and that's when I expect to see a catalyst that will push AMC up enough where the hedge funds won't have enough money to service those margin calls, and you will see massive amounts of shorts covering at the same time. So that is my take on the situation. I wanted to clear up these couple details and just show you guys how vulnerable the markets are at this current moment, how much debt is out there, how much direct and indirect exposure the banks have to Russia and China. And the direct exposure and indirect exposure to China, you can't even put it in dollar amounts. It's well over $1 quadrillion. So that's going to be all for this video. Hit the like button and subscribe to the channel if you guys have not already. If you guys want to join the trading community, link down below in the pinned comment and get yourself free stocks. Links for Moomoo, Webull, and Public in the description of this video. Right now, if you sign up with Moomoo, deposit $1, you will get 3 free stocks. And by doing that, you will get those free stocks plus a free share of NEO just for doing that. I don't know where you can get a better return. If you guys know, then surely let me know down below in the comment section. As always, let me know your thoughts on this as well in the comment section. Thank you guys for watching, and I will see you in the next one.